Perhaps, but let me start there. I think that we have an excellent overview of the sector and of the challenges that it faced. And in some sense, this is a chapter that illustrates quite nicely the theme that has been noted by several people, that there are both winners and losers in a context like this. Agriculture overall did well, but nonetheless, the chapter illustrates how some parts of this sector experienced quite substantial negative shocks, and of course, the parts of the sector affected by the alcohol and tobacco bans are a good example of that. I think that the emphasis in the chapter, Erica talked quite a bit about this, on the informal trading connections, impact on small businesses, but particularly informal food trade activities is very interesting and useful, and certainly is an aspect of this report that I think highlights issues that will need further attention as we go forward, and Pandima has talked a bit about that. But I want to, in moving on really to the broader macro perspective, I want to say that alongside the obvious sense in which there are winners and losers in a context of a huge economic shock like this, there's also a general sense in which the negative impacts are felt much more broadly than just sectors that are directly affected by regulations or the changes in global trade that occurred in the wake of the pandemic. And that, I think, is a theme that it would be useful to take further in more depth in the next round of work on the macro perspective. We've got quite a useful overview of the fiscal and monetary aspects of the macro context and the challenges that the pandemic brought. But there's been quite an interesting bit of work done by the Treasury and Reserve Bank economists in collaboration with the UN wider towards inclusive development economics economy research project, reflected in a recent paper that's published in the UN wider site. It's work by Channing Arndt, Rob Davies, and co-workers from several other institutions. It's a paper entitled "The Impact of COVID-19 on the South African Economy: An Initial Analysis." And it's essentially an argument that you have to think differently about the impact of the pandemic on the economy than we usually think about in a general economic framework. Think about recessions. A recession works its way through the economy through overall loss of confidence, impact on financial asset markets, perhaps the willingness, particularly the financial sector, to lend, a sort of a credit constraint, and then it feeds through across the economy as a whole in a broad sense. The pandemic and the lockdown associated with it initially impacts through specific impacts on sectors and activities that are subject to sudden changes in regulations or sudden changes in international trade, like the tourism sector. And then there are feed-through impacts to the rest of the economy. And what the Channing Arndt and the UN wider team have done in this work is illustrate quite nicely how just a fixed coefficients input-output type perspective, a social accounting matrix perspective on the economy, provides useful tools for modeling that impact. And of course, that's exactly what we've seen. We've seen impact across manufacturing, not just on the essential services, but much more broadly than that. We've seen impact clearly of the loss of tourism revenue in the catering and accommodation and restaurants industry, but that feeds through into also demand for particular food products and the alcohol sector. So the impact on the alcohol sector, which we tend to think of as a consequence of a ban in our context, and that's an important part of it, but it was also an impact of loss of tourism revenue, and so what that sort of what they call bottom-up perspective on the impact of the recession tells us is that that you have to think about the difference between the impact of domestic regulations and what's going on in the domestic economy and the impact of the broader global context and of changes in behavior. They make some estimates of what those impacts are. They come out at roughly 40, 50% perhaps of the impact in the second quarter of last year associated with domestic regulations. Some substantial share of the impact is not about our regulations, it's just about what's going on in behavior change and in the economy more broadly. So I think that's a good way of thinking about the interconnectedness of things, and that's in an important sense what economics is about. But what strikes me very strongly about these chapters is, and I'm sure that this is true, Janine and Marie, about the whole project. You've had the huge task and the privilege, I suppose, of looking at all of these chapters. I've just looked at 3 or 4, and they illustrate just how important the interconnectedness of what governments do and what businesses do, and social stakeholders, organized labor. And I'm going to say a few things about that because I really think that that's a very substantial contribution that this whole body of work can make to our thinking about economic, not just about the response to the pandemic and the economic shock associated with it, but also the economic recovery challenge for the period ahead. The mining chapter really provides, as I read it, a very good illustration of how an industry, quite a well-organized industry, working with a government department, sometimes in conflict with it, but recognizing different roles and responsibilities, taking advantage. There's an example given of the work of the Council for Geosciences in addressing the rockfall risks in contexts where a mine has ceased operations for a significant period of time, and so opening up those operations means that particular geological risks need to be addressed. So good examples of how the scientific capacity of the state here and its institutions, of the industry in an organized way, and in respect of occupational health issues, collaboration with unions and the responsible regulators, were able to get the industry going again quite quickly. So in contrast really to manufacturing, where it seems to me the chapter illustrates much weaker kinds of coordination between business, organized business and industry representatives and the responsible government departments. In respect of tourism, the question raised about the appropriateness of restaurants belonging to or falling under a tourism department is another illustration of a kind of public-private coordination failure. I think there are really interesting lessons to learn about that kind of collaboration, and lots of examples of it. Several speakers, both in the context of agriculture, in the context of manufacturing, in the broader economy, in the context of the restaurant industry, have talked about the impact of the pandemic on small businesses and the informal sector, and by implication are pointing to the inadequacy of our policy response, but also, I think also to the shortcomings in the institutional capacity of government working with business institutions, the banks, lenders, support organizations, municipalities, to respond to the needs of the informal sector and small businesses. I think taking forward some of the ideas, some of the points that Harold has made about the role of credit and the capacity of the banks to respond to small businesses, and the take up and impact of the credit initiatives that were introduced last year by the SA Future Trust and then the loan guarantee scheme. I think that what is illustrated there is really deep institutional shortcomings in our capacity to work with and meet particularly the credit needs of small businesses. And you have to say that whereas the SA Future Trust initiative, with about R1 billion on the table, got funding out to about 10,000 small businesses during the course of the sort of core 6 months last year of the pandemic. The loan guarantee scheme, much slower to get going, and just something like 18 billion going to around 15,000 enterprises by early this year, in a scheme that was intended to provide credit backing of up to 200 billion. It's a huge failure, and a huge failure of coordination between the banking system and the Reserve Bank and Treasury, who wrote the rules and were underwriting these arrangements. I would characterize the failure as a failure to recognize that this was a context in which what was needed was a lower cost of credit for a longer period of time. Instead, the scheme was designed to provide additional credit to businesses wanting to perhaps borrow to invest or keep their businesses going. But as the governor of the Reserve Bank has said on several occasions, this was not a context in which business was wanting to borrow more. This was clearly a context in which business was reluctant to borrow, and so you had, in fact, quite a bit of deleveraging going on. The credit should have gone into replacing debt with lower cost debt for a longer period of time. That's the maturity transformation function of the banking system. And it feeds through into, this is a financial sector issue, and we've got the financial sector bit contribution to the economic chapter here, but it feeds through and into really all the other sectors of the economy. And so the extended impact of lower economic opportunities and lower employment as we go into the third and fourth quarters, despite the economy picking up again, is in part a consequence of the inadequacy of that capital market response and a failure to recognize the need to extend credit over a longer period of time at lower costs, subsidized in part by a guarantee or official underwriting. The weakness of the maturity transformation response in our financial response to and monetary response to the pandemic, of course, is also reflected in the steepness of the yield curve. And the steepness of the yield curve made it hard for banks to do that longer term maturity transformation, to be very straightforward about it, to convert short-term overdraft facilities into lower cost, longer term debt that would enable businesses to see themselves through over a 2 or 3 or 4 year period, see themselves through the adjustments that's needed. So I've made some quite specific points there about interconnectedness that I think come through well if you read between the lines of these reports. I want to talk in particular about a really interesting graph that is in the economic sectors, the finance chapter, that illustrates what happened to credit extension last year. And it really surprised me when I looked at it. The discussion of it, I think, is incomplete. I think, Harold, you could expand on this in interesting ways. And what it shows is that credit extension in the economy in 2020 rose rapidly in February and March last year, in the 2 months preceding the start of the pandemic. Credit extension rose and then flattened off, and there was very slow growth for the rest of the year. So we had almost an anticipation of what was coming in the reinforcement of the uh, liquidity of businesses, perhaps also of households, and also of government in February and March last year, and then deleveraging over the course of the rest of the year. Uh, uh, that's an interesting finding, and I think it needs to be explored further. You dig into the numbers in that the Reserve Bank publishes, it turns out that government accounts for about 100 billion of the 250 billion or so of additional credit extension in February and March last year. The private sector accounts for the rest. So one has to say you had a build-up of credit, a strengthening of the liquidity of government, a pre-financing by government that continued, in fact, later in the year into 2020-21. So you've got a lot of pre-financing of government's needs by March this year as well. And the lack of take-up of the loan guarantee scheme may in part be a consequence of that pre-funding that occurred in the early part of the year. I think that really needs to be examined further, and its impacts through different sectors of the economy perhaps examined a bit more closely as well. Okay, let me say one or two other things about connections. The agriculture chapter makes good points about the whole value chain through, for example, to the restaurant sector, the impact of the alcohol ban on restaurants. I think more could be made of that. It turns out that the markup on alcohol sales is a hugely important part of the viability of the restaurant trade, and so earlier relief in that part of the regulatory response would have assisted the restaurant sector more. I do think that that's an illustration of the point that is made in the chapter, that there's not very good coordination. Erica showed us a quote, not very good coordination and responsiveness of government to an industry that is, in the nature of things, quite difficult to organize, and so quite difficult to respond to. There's a general lesson there that I'm sure has implications right across the economy, that strengthening the vehicles through which business is organized and relates to government around contexts of regulatory change need to be strengthened going ahead. There's one recommendation in this chapter that that struck me as quite inappropriate in this context, and it's a recommendation towards the end of the tobacco section of the economic services chapter that says we should follow World Health Organization advice, and governments should never consult with, never take advice from the tobacco industry, should make their decisions and implement them. Which I think is a completely inappropriate recommendation in the context of the democratic institutions of governments and their reliance on interaction and good communication and good coordination relationships between government and stakeholders and interested parties. But it's also a particularly offensive recommendation in its implications of the way government bureaucrats, the integrity and the intelligence of government bureaucrats in dealing with industry. So I would not want this report to recommend that government should not consult with the tobacco industry, or any industry for that matter. I think the overwhelming recommendation has to be stronger coordination, stronger collaboration and partnership between government and economic stakeholders is needed if we are to respond better to these kinds of challenges in future. And let me finish with something that is important in the macro chapter, but of course has implications right through other sectors as well. And that is the relative impact, the appropriateness and effectiveness of the TERS response, the temporary employee employer relief scheme response to loss of earnings by workers. So the big impact right across the multiply mechanisms, as I've said, mean that this was very widespread across the economy in April, May, June last year, are evident in the data. It's not the case, as the finance chapter suggests, that within the financial sector there were almost, the chapter says something like there was no evidence of distressed firms. Actually, if you look at the employment statistics, there were 100,000 jobs lost in manufacturing. There were 170,000 jobs lost in the overall financial sector that includes real estate and brokerages and the insurance sector and leasing activities. When you dig into those numbers, there's some sectors that were quite badly hit in the second quarter in particular. Leasing of businesses just almost closed down, and so you had quite big job losses, and I'm sure there were business failures as well in the parts of the financial sector that in which smaller operators are involved in that kind of activity. Clearly, the impact on parts of the commercial real estate industry, illustrated well in that real estate section, Harold talks about that, are other examples. So they feed through right through the economy, loss of earnings and loss of jobs, at least in that period of level 5 and level 4 lockdowns. The TERS UIF response was intended to fill that gap. It's not the case that it was decided on too late. The decision to use the accumulated reserves of the UIF to provide relief through a temporary employment relief scheme was taken before the start of the lockdown. There's a mistake in the chapter about the size of the initial response as being only 3.7 billion. That's not the case if one includes the TERS response, which was decided on towards the end of March last year. There might not have been a number, but there was certainly a recognition that the TERS program was going to cost 30 or 40 billion. By early this year, it's closer to 60 billion that has been provided in relief to employers and employees to meet wages lost or partially lost during the pandemic. But the TERS program is a really good example of the point that was made by in both the macro chapter by Heinrich and alluded to by others, that it's not just policy response, it's not just the fiscal decisions that counts, it's the institutional capacity to get things done. And the reality is that the TERS unemployment relief flowed to businesses or flowed to workers very, very late, often 2 or 3 months after the months in which earnings was lost and for which claims were made. And when the state of disaster was extended, lockdown was extended again in October, November, December, January this year, there were long delays in decisions about whether the TERS benefit would be extended or not. And we are still, as we speak today, in May, processing claims from businesses or employees from October, November, December last year. Well, a cash flow relief scheme that's intended to meet the household cash flow requirements that are lost because of a temporary shock to employment in the economy has to have the institutional capacity for those cash flows to flow with as little delay as possible, within a week or two of the end of a month, if they're to have the desired effect. In the US, the equivalent program simply comprised of a surplus of $300 added to the weekly or monthly unemployment benefits that were paid through the American equivalent UIF system. Immediate cash flow into households, supplemented also by transfers to almost all households through the revenue authorities as well. We would have done better if we had made use of the revenue services, more direct relationship on a payment basis with businesses to implement the UIF. But we certainly, for the future, need to build the institutional capacity in the unemployment insurance environment to get cash flows to benefiting businesses or individuals much more quickly. It turns out, when you look at how the UIF works, that ordinary unemployment benefits also typically flow several months after the month for which the benefits are earned. in the UIF credit-based system. That's an institutional weakness that in effect has emerged in the context of our experience of the last little while, and that I think is a priority for addressing in the future. I think it's one example of that general message that strong institutions addressing the fragile state of the economy and weakened institutions, which was a phrase that Heinrich used in the early parts of his presentation. Addressing the weaknesses in institutions is has got to be a strong theme of this report, and taken forward through the through government and its collaboration with industry in the period ahead. Of course, there's some examples of institutional capacity that has been able to respond quickly. The social grants benefits moved more quickly. I also think that we should recognize the extraordinary achievement of the presidency in its special employment programs in getting the youth employment initiative of 300,000 odd additional assistance in schools, getting that program going in just a few months towards the end of last year. We need more initiatives of that kind, not just implemented as government employment programs, but also by businesses, and businesses in collaboration with municipalities. And perhaps that employment theme is one that could be taken further in the next phases of this work. So I hope that's a few useful comments that are sort of overlapping themes through these chapters. There's a lot more to be said. I want to echo what Pandiwe and others have said, that the authors have done a great job, often with very short time constraints, and Janine and Marie have done an extraordinary job in bringing all of this together. Thank you very much for that.